Hello, I'm Donna Sawyer from the Finance News Network, and joining me from data analytics and credit information company Veda Group is Angus Luffman. Angus, welcome to FNN.
Thanks, Donna. Nice to be here.
Veda has just released its Consumer Credit Demand Index for the December quarter. What were your findings?
What we found was that the Consumer Credit Demand Index, which measures unsecured credit demand, being personal loan and credit card applications, was relatively stable for the quarter, with personal loans down slightly 1.5% and credit cards up 2.5%. In that underlying figures, what we found is that personal loans have actually stabilised after a long period of growth, and credit cards, whilst a relatively low growth number, is actually in positive territory for the third consecutive quarter, which is a good sign after many quarters of decline leading up to that period.
You say mortgage inquiries lifted by over 15% year on year. Do you see that as an indicator that confidence is returning to the property market, and what's behind it?
Yeah, sure. So we've watched mortgage inquiries and demand grow over the course of 2013. And like you do see in mortgage or property demand, it's actually been geographical and been led really by New South Wales originally, and then more lately the other eastern seaboard states. But really we've got positive territory right across the country in terms of mortgage demand, and certainly the other thing we found is that our mortgage demand index seems to be a pretty good indicator of house price growth with a sort of 2 to 3 quarter lead time, and housing turnover, and certainly that seems to be the case we see in the market.
Do your figures tell you anything about market demographics? For instance, what are first home buyers doing?
Yeah, look, they do. We've looked into those simply because there's been a lot of commentary, obviously, about this has been an investment-led style growth in applications, which are up 15% for the quarter. But whilst we can't see the investment part of that growth, when we look at the demographics, we find there's look like a real swap between the lowest, sort of the youngest demographic, 18 to 24, and the oldest demographic, been a swap really from the young to old. Whilst the demand predominantly still comes from the mid demographics, obviously 25 to 45, that switch is a trend and a growing trend. So that seems to support the theory of a more of investment-led boom.
So were there any hotspots? Where did you see the most mortgage inquiries?
Yeah, sure. So as I mentioned, the New South Wales was a really strong result. It was up 22% for the quarter over the previous quarter last year, and that's how we measure it versus the prior year. But it was really double digits right across the eastern seaboard, and that meant we went from about sort of high single digits to 15% in that quarter, which is a very strong result. So really, it's the pickup in the eastern seaboard that has really driven that growth, but positive growth right across the country.
Angus, based on this report, are you able to provide an outlook for mortgage demand going forward? Are you seeing any trends emerging?
Look, I think what the Bureau measures here is it's a lead indicator. So it's an intention to spend, and certainly what it showed early in 2013 then became the case of a growth spurt. I think in terms of how long that lasts, that's really down to what are the conditions that pervade to support that, and that's really about stability, favourable investment conditions, obviously low interest rates, and also possibly the feelings about overall equity position of consumers. So, if there's growth in share market, I've got available equity, I'm comfortable to spend more or borrow.
It seems that while there's been an uptick in mortgage inquiries, personal loan and credit card consumer activity appears softer. What are you seeing there?
Look, personal loans, I'll start with personal loans. That's had a really strong growth period for the last 18 months. And I mean, quite marked growth to the point where personal loans outstripped credit card applications for really the first time for an extended period. That's stabilised, it hasn't dropped, and so it's stabilised at a higher level. I think the strong growth we've seen there has clearly been driven by the car market, and that has favourable conditions for a good part of that 18 months, notably a high Australian dollar, which obviously helps, and particularly the imported cars. I think with the change in the Australian dollar position that we're seeing, it'll be a question how much that carries forward. And then generally in personal loans, it's about how comfortable consumers are using sort of unsecured finance or personal loans for the purpose of other larger purchases. And certainly there's some movement in sort of the mining states there which is softer, which may indicate that I think the moment we'd hope for a stabilised of that position, and really subject to those two factors. In relation to credit cards, as I said, there was some underlying factors there which show a positive sign in that market. On top of that, credit cards can often be driven by activity in the market, and clearly we're seeing a number of major sort of card companies and banks put out offers in the market right now, which would kind of indicate that there'd be continuing demand. I think the question in that market is that aside from that sort of turnover or growth or churn that might happen because of offers in the market, is whether the overall balances outstanding change. So underlying total credit growth actually changes, because certainly in the credit card market we've seen a sort of a drop in that overall balance outstanding really since a year or so after the GFC. So I think it's a question of what we see in that underlying growth in balances is what will be another interesting thing to look at.
Finally, Angus, the property market appears to be in recovery mode. Do you think that will continue?
Look, obviously we're capturing an intention. That has had a continued and accelerated growth. We know that these things move in cycles that last a particular period, and I think it will come down to a set of conditions that continue to enable that. Obviously interest rates will be part of it, obviously valuations are part of it, and then stability of other items, other elements in the economy that make consumers or investors feel comfortable to continue to be in that market. And so certainly I think the sort of autumn period, which typically has pretty high activity, will be a portent to that, and to how much sort of sustained growth we'll see.
Angus Luffman of Veda Group, thanks for your time.
Great, thanks for having me on your show.